Hello, and welcome back to our channel, where we empower you to make smarter financial decisions and build wealth like the rich. If you've ever wondered how millionaires make their investment choices and what they avoid, you're in the right place. In this video, we'll explore 7 things the rich never invest in. And by understanding their strategies, you can make better investment decisions and pave the way to financial success. So, without further ado, let's begin. Learning from the rich. It's no secret that millionaires are avid investors, constantly seeking ways to grow their wealth. To understand their approach, let's take a lesson from the legendary investors like Warren Buffett and Charlie Munger. These moguls didn't invent their strategies, they learned from their predecessors. Warren Buffett's mentor, Benjamin Graham, authored The Intelligent Investor, emphasizing meticulous financial evaluation. Investing is indeed an intricate art, and knowing what to avoid is as crucial as knowing what to invest in. Number 1. Bonds. While some millionaires hold bonds, they do so with caution. Bonds offer lower returns compared to stocks, averaging around 3% annually. Given the inflation rate of about 2%, this leaves you with minimal real returns. Bonds are lower risk and liquid, but are better for wealth preservation than wealth generation. Millionaires avoid allocating substantial sums to bonds in their portfolios. Number 2. Penny stocks. These stocks, typically trading at less than $5 per share, are often viewed by the wealthy as highly speculative and are typically avoided. One of the key issues with penny stocks is their lack of regulatory oversight. Unlike larger companies listed on major stock exchanges, these smaller firms are not required to register with the Securities and Exchange Commission, SEC. Consequently, they aren't obligated to present their annual reports. This lack of oversight and transparency results in volatility and unreliable financial information. Low access to credible financial information makes it incredibly challenging for investors to determine the true value of their holdings, a critical factor in making informed investment decisions. While it's true that penny stocks have the potential for exponential gains, these gains often come with extreme risks. The wealthy know that the allure of penny stocks is often offset by their inherent volatility and uncertainty. Moreover, due to the limited popularity of penny stocks, they trade infrequently. Finding a buyer for your shares can be challenging as compared to highly traded stocks that change hands thousands of times a day. This lack of liquidity also complicates the process of gauging the actual value of your holdings and can create stress and uncertainty for investors. For these reasons, millionaires tend to steer clear of penny stocks. Number 3. Digital currencies. While cryptocurrencies like Bitcoin have made headlines, they are often bypassed by millionaires. It's true that some individuals have amassed significant wealth through digital currencies, but these cases are the exception rather than the rule. Digital currencies face several significant challenges. First and foremost, they lack government regulation. The absence of oversight into how the companies behind cryptocurrencies operate can be concerning when substantial sums of money are at stake. This regulatory vacuum can lead to fraudulent schemes and price manipulation, making digital currencies a risky investment. Another challenge with digital currencies is that they lack intrinsic value. Their prices are purely speculative, similar to penny stocks. This means that their prices can surge when there's hype around them and plummet when attention wanes. For instance, during the Bitcoin boom in December 2017, its price skyrocketed to over $17,000 USD. However, a year later, it had declined to just over $3,000 USD. The volatility in digital currencies can result in significant financial losses for investors. Finally, unlike traditional investments, digital currencies are vulnerable to hacking and theft. The history of exchanges and wallets being compromised is far too common. For example, Bitfinex, a Bitcoin exchange, was hacked in 2016, resulting in depositors losing over $70 million. Number 4. Certificates of deposit. Certificates of deposit, CDs, are another option that millionaires tend to shy away from. These financial instruments, offered by banks and credit unions, provide a modest interest rate in exchange for locking your funds for a predetermined period. While CDs are a safer choice, they fall short in terms of returns, with the highest rates as of September 2019 only offering a 2.25% annual yield. This rate barely keeps pace with inflation, which means you're essentially preserving your wealth instead of growing it. Furthermore, while CDs typically have shorter terms than bonds, reducing the time your money is locked, they don't offer the robust returns that millionaires expect to expedite their wealth accumulation. As a result, these conservative investments aren't the go-to choice for the rich, who often seek more lucrative opportunities to build and grow their wealth. Number 5. Collectibles. The world of collectibles, encompassing art, antiques, classic cars, wine, and even comic books, might seem enticing, but the wealthy tend to avoid them. Collectibles, unlike traditional investments like stocks or real estate, don't have a definitive market price. Their value is highly subjective, dependent on what a potential buyer is willing to pay. This is akin to cryptocurrencies, where the asset's worth is based on perception rather than objective monetary value. Another drawback is that collectibles don't generate regular income. While owning a valuable painting or classic car can be fulfilling, they won't provide monthly income streams that many wealthy investors seek. The most significant challenge is their liquidity, or lack thereof. Finding a buyer willing to spend significant sums on collectibles can be a lengthy process, leaving your invested capital tied up. This makes collectibles a less attractive option for the rich who prefer investments that offer both growth and liquidity. Number 6. Precious metals. You might wonder why precious metals like gold aren't a favored choice for the rich. On the surface, it seems like a sensible hedge against economic downturns. Precious metals tend to have an inverse relationship with the stock market, meaning they can rise when stocks fall. However, in practice, precious metals often don't appreciate enough to offset losses during market downturns. Furthermore, holding precious metals can be as illiquid as the other investments we've discussed. If you're in a financial bind and need to sell your gold or other precious metals, it may be more challenging than you expect to convert them into cash. And if you need more convincing, consider the perspective of the investing guru Warren Buffett. He famously views gold as a poor investment and consistently highlights the superior historical returns of stocks compared to precious metals. For example, if you had invested at $10,000 in both gold and stocks in 1942, your gold would be worth around $400,000 today, whereas your stock investment would have grown to a remarkable $51 million. Number 7. Companies you understand. At this point, it's clear that stocks are a favored investment among the wealthy, but not all stocks make for good investments. This is because there are numerous companies listed on the stock market that are so complex that the majority of investors can't even grasp what the company does. Even Warren Buffett, with his vast experience, restricts his investments to businesses he understands. Buffett preaches the importance of investing only in companies within your circle of competence. This is the area where your expertise lies, and it's essential to limit your investments to businesses that fall within this circle. Buffett argues that if you don't understand the business, it's challenging to project its performance. For instance, Buffett wasn't significantly affected by the burst of the tech bubble in the early 2000s because he wasn't heavily invested in complex tech stocks. If you want to invest like a millionaire, remember to avoid these 7 investments. By following these principles, you can make more informed investment choices and take a step closer to achieving your financial goals. If you found this video informative, don't forget to hit that like button and subscribe to our channel for more amazing content. Together, we can help you transition from the life you have to the life you truly deserve. Thanks for watching, and we will see you in our next video.